All right, in this lesson, we're going to talk about how internal controls actually impacts cash and just kind of give you an introduction of cash, which is what we're going to spend most of the rest of this section on. And internal controls and cash are super important because of the high susceptibility cash has for theft. So let's talk a little bit about internal controls for cash. Now, let's start this by asking you kind of one simple question. If I were to leave this table in a classroom, for instance, what is the likelihood that this table would be stolen? Probably not high, right? I mean, you can't really tell from this photo, but probably a big table used in the classroom. Probably this is the teacher's table, for instance. Hard to maneuver, probably nobody really wants to steal it. So there isn't this high susceptibility that this table would be stolen, right? All right, so let's flip to another example. What would happen if I, let's just say, put this $100 on the table in the classroom? What's the chances that it would be there tomorrow? Well, probably a little less likely that it will be there tomorrow, assuming that we're on maybe a college campus where everybody has access to the classroom. We're not talking about a classroom where like you are in grade school and your teacher has the key and the custodians have the key and very few people have the key. But we're talking about, pretty much a public classroom. So what's the susceptibility that this would get stolen? Probably very high, right? Someone can just take it and then it's gone forever, right? So why is this important? Well, why is the paper, because really, money is really cloth in the United States, not paper, but cloth. Why is the cloth, like a $100 bill, going to be stolen by the next day? What makes it valuable that it is acceptable to be stolen? Well, what makes it valuable is that we, the people, have put value in that piece of paper. What value? Well, in currency terms, we have valued it at $100 US. So there's this risk that cash is going to be stolen. And it was an easy idea to talk about, right? Because we said that if we put $100 there, what's the chance it's going to get stolen? There is a high chance that we would all agree that it would get stolen. And so this is where internal controls is most important when it comes to cash, okay? So what is that idea that this $100 bill could be stolen very quickly? Well, it has an inherent risk. Cash has a high inherent risk of being stolen because the public, me and you, give that piece of paper value, lots of value. Now, we're not taking away that the table doesn't have value. It has value. It just doesn't have as much value as that $100 bill. So we have given it this inherent risk, the risk that it can be stolen, very high. Companies need to have stringent internal controls surrounding cash because of the inherent risk it will be stolen. There's a high value, therefore there's high stakes, and it also has high inherent risk. The inherent risk that it can be stolen is very high. What's the inherent risk that the table is going to get stolen? Not high enough, right? So there is some risk. There is some inherent risk that it could be stolen because it is valuable. It's just a little bit awkward, right? So you're going to have to need multiple people to steal it out of a building in public daylight, a little bit less harder to do than just taking a $100 bill, putting it in your pocket and walking out the door. Now, companies have a lot of volume of cash that they deal with, and therefore the susceptibility of errors and theft and fraud is high, assuming that people have access to it. So you might go, well, a lot of transfers are done EFT-wise or electronically, and that is true, but there is also fraud that can happen there as well. Now, cash, what creates this inherent risk, this high inherent risk for cash? Well, cash is one type of asset that cannot be traced to an individual, and therefore it is owned by the person who possesses it. When was the last time that you wrote down all the serial numbers on every single dollar bill that you got? So how can you prove that $100 was yours? Unless you have videotape of someone actually taking it out of your hands, nobody really can say that that is yours versus theirs. So because it is owned by the person who has it, this is the 9/10 rule, right? 9/10 of the law, possession is 9/10 of the law. Well, the reason for that is because you have no way of saying that that is really yours unless you wrote down all of the serial numbers. And then when we review those serial numbers to that stolen bill, we can match them up. Right? So it is extremely portable and valuable. So that's why we have to have internal controls on cash. Now, where internal controls is necessary when cash is involved, where is it necessary? Well, here is where it's necessary. So the first part it's necessary is in the cash receipt. So either in-person receipts or remote sources. So in-person receipts may be a customer coming to the store and giving the clerk the money in cash. So there is susceptibility of fraud there and theft there. So we need to have internal controls on that cash receipt. And then there's remote sources. Remote sources may be someone else off-site collecting cash or credit card transactions and processing it there and then depositing it with you. So this is a great example of that would be off-site sales. So a company typically has their business at their business location, but then they go somewhere else for an off-site sale. Now we have this remote sources of income that we need to deal with. Credit card transactions sometimes can be thought of as that way because you don't get the cash right away, you get it later on. Now, so that's one aspect where internal controls are important. Another aspect is also on the cash disbursements or the cash payment. We see this through either check payments, ETF payments, as well as petty cash. So we need to have internal controls related to those areas because we don't want cash to be dispersed to people that shouldn't receive the money, or we shouldn't have checks that are dispersed to the wrong people for the wrong amounts. That's bad internal controls. So we need to have internal controls that are related to those in order to make sure that all of our cash has the right custody in its disbursements. So that is a look at internal controls and cash. So really what this was about is helping you understand why cash is valuable and susceptible to fraud, and then why we need to have internal controls as part of cash because of the high probability that theft or fraud could happen with cash because of its portability, because of its valuableness, and because it can't be traced necessarily to the person who took it. So that is our lesson here on internal controls for cash. Hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, it is Patrick. Don't forget to press the like button and share this video with someone who could get a lot of use from watching this lesson, like maybe a classmate or maybe a friend or maybe just a parent, just because you wanted to share this video because you're very excited about what you saw. Share it with someone. And if you want to help us grow and help us make sure that we put the very best in accounting topics out on YouTube, make sure you press the subscribe button and turn on that notification bell. That way you're alerted every time we post videos to this channel. Now, I do this with every one of my classes at the end of class. What did you learn from this lesson? Put that in the comment section below and I'll respond to you on what you got out of this video. So hope you enjoyed this video and we will see you in the next lesson.